I'm recording, so clean up your act. I think it says recording. Okay, we're recording apparently, so welcome to chapter 4. The nice thing about chapter 4, well, maybe I should ask you, what's the importance of chapter 4? Yeah, pricing. Yeah, if you know what your unit cost is, you know the minimum price you can charge without losing money. And it gets a little complicated if you have a multi-product firm, like most firms are multi-product, they sell more than one thing. But if you can estimate what your cost is on a per unit basis over a wide range of activity, then you know what the minimum price is that you can charge without losing money. Now, what if the minimum cost to you is $10 a unit and everybody else is buying it for $8 from the guy down the street? What do you do then? Your minimum cost is $10 a unit, somebody else is selling it for $8. What do you do? Yeah, if your cost is 10 and somebody else is selling it for 8, you just don't sell that product, right? Because you're losing money on that. So you sell something else. So I think I mentioned that like last week or 2 weeks ago. I had a case like that. Somebody was losing money because someone down the street was selling for less than her cost. So I told her, don't sell that product anymore. Sell something else. Yeah. But you wouldn't know that if you didn't know what your unit cost was. So this chapter is about unit cost for job order costing. And the first part's pretty straightforward. Then it gets a little more complicated, but still not too bad. There's really nothing complicated in this chapter. It's just that some stuff is simpler than some other things. So this is about job order costing. There's another kind of costing that begins with P. You remember what that one is? Do you recall reading? P. Process costing. Yeah. This chapter, or this book rather, doesn't deal too much with process costing. It almost skips process costing entirely, but that's okay. We don't have time to cover every possible cost subject. I used to teach out of a cost accounting book. It was like 35 chapters. We did it over 2 semesters. So there's a lot of stuff we're leaving out. But that stuff is available in different cost accounting books. This is like cost accounting light. They call this managerial accounting. Cost accounting is a little more heavy duty. But like you like heavy duty? I like cost accounting better. You do? Oh, okay. Oh, yeah. Yeah, it's logical. It follows the same thought process as this. It just gets into a little more detail. So, yeah, the reason I mention that, in case you have to get into this at some point in your career, and this book doesn't go deep enough, there are other books that will go deeper. So maybe you'll have to do some of this stuff, or maybe you'll hire someone who has to do this stuff. You have to understand what the problems are and what the solutions are, pretty much. If you hire somebody to do this, you have to understand what they're talking about when they tell you something. You have to know what questions you should be asking and so forth. And again, there's deeper stuff you can get into if you want to, but not this semester. So job order costing is used when many different products are produced each period. Products are manufactured to order. You may have orders from different people. They may say, we want this, and we want a couple other things, bells and whistles put on. You have to estimate what the cost of including those bells and whistles might be. The unique nature of each order requires tracing or allocating costs to each job. We didn't really deal much with manufacturing overhead so far. We put it in there because if we left it out, that would be incomplete. But in this chapter, we allocate it to certain products a little bit. There's going to be more on that later, too. Examples of companies that might use job order costing: Boeing, an aircraft manufacturer. They might get an order for 20 airplanes, so they have to figure out what's the fixed cost, what's the variable cost, over how many units can we spread that fixed cost, things like that. Bechtel International, large construction company. Each construction project is separate and distinct. They're all different. Hallmark, greeting cards. Each greeting card's a little bit different, although they do follow a certain process. I might also mention that of these two systems, job order costing and process costing, they're not necessarily mutually exclusive. You could have elements of both. Like process costing, for instance, would be if you have a petroleum company. You dig some sludge out of the ground and you turn it into different octane gasolines and oil products, petroleum products, a few other things maybe. It starts off as one common thing, just sludge that you pump out of the ground, and then you turn it into things using a process. Or let's say you're a farmer and you grow wheat or corn or barley or something. You process that using a certain system. That would be a process cost system. So you could have something like that as well. That's a different kind of cost accounting, which isn't too complicated either. But this chapter is only about job order. That's the other kind. If it's not a process costing system, it's probably a job order costing system. Although there are hybrid systems that incorporate elements of both. Here's an example. Again, you charge direct material and direct labor cost to each job. And you could have several of those. What element is missing? Because how many types of manufacturing costs do we have? 3. These are 2, direct materials and direct labor. Which one's missing?
Overhead.
Overhead, right? Manufacturing overhead, right. You can charge direct material and direct labor directly to jobs. You have to allocate the overhead costs because you can't trace them, at least not easily, to any particular job, like the janitor's salary, for instance, or the president's salary. Or, well, the president's salary wouldn't even be allocated, would it? Why would the janitor's salary, the janitor for the factory, the janitor's salary would be allocated to these projects, but the president's salary would not? Why is that?
The president's is SG&A.
Well, I'm hearing voices in cyberspace. Yeah, that's because the president's salary is an administrative cost, right? Yeah, and here we're only talking about manufacturing costs. Yeah, the 3 kinds: direct material, direct labor, and manufacturing overhead. The president's salary would be an overhead cost, but that's administrative overhead. So it would not be part of the manufacturing process. Yeah. What kind of cost is manufacturing cost? Is that a period cost or a product cost? Period? What's your second choice? Begins with P? Product. Yeah, it's a product cost because you deduct it when the product is sold. So if you made 100 units and you only sold 80 units, you'd only deduct 80% of that cost this year. And then what happens to the other 20%? Next year. Becomes ending inventory this year. It becomes beginning inventory next year. And if you sell it, then it becomes part of cost of goods sold. You notice I'm repeating myself, right? That sometimes repetition is good.
Yeah.
And this is one of those times. There's a lot of carryover from chapter to chapter. Manufacturing overhead, including indirect materials and indirect labor, are allocated to all jobs rather than directly traced to each job. Again, that's the difference between direct and indirect. Direct costs, like direct material, direct labor, you can trace those to particular jobs. If you make automobiles, every automobile has one steering wheel. You can trace that to the cars. The janitor's salary, you allocate among the various products you make. You might make 18 different models or 12 different models or something. You could allocate that, but you can't trace it directly. Here's a job cost sheet. They still have these things, although a lot of stuff is now done by computer. Look at how it's structured, the various categories. In the upper left, they have job number, A143 in this case, and then when the job was started, they initiated, date completed, units completed, and what department it's in. You may have a job that goes from department to department. You could have an assembly department. You can have a department that spray paints, whatever it is. You could have a couple other things, a milling, machining thing. You know, if you have metal and it has sharp parts, you might have a department that sort of shaves off those sharp parts so nobody gets cut and so forth. So you have direct materials, requisition number and an amount, direct labor, some columns for that, then manufacturing overhead. You have the three types of manufacturing cost, and then the cost summary down there with some additional information in columns. And then they start filling it in. In this case, for the materials requisition form, you have 2 times 4, 2 by 4 perhaps, 12 feet worth of that, quantity 12, unit cost 3, so 12 times 3 is 36, 20 times 4 is 80, and so forth. So you get this cost for materials. And then we have a job cost sheet here for pair company, where you have direct materials might be 116. You put that here in the direct materials column. You'd also have direct labor and overhead, the total cost, and then the unit cost would be just the total cost divided by the number of units. Here we have starting times and ending times. This would be a time ticket for an employee called I Am Skilled. Have you ever met that guy? No. It's an employee, I Am Skilled. Starting time, ending time, number of hours, hourly rate. It gets a little more complicated when you add fringe benefits. We're not going to do that in Chapter 4. This is just a sort of light example just to show you what a job cost sheet looks like for labor hours. If this employee works on 3 different projects, you could trace that costs and allocate it to the various projects. And then again, the direct labor costs would be there. So we have direct material, direct labor, manufacturing overhead, a little more difficult to compute, but not impossible. So we have this thing called a predetermined overhead rate. When do you compute that? At the beginning of the year, or the end of the year, June 30th? Predetermined. Begins with B.
Beginning of the year.
The beginning of the year, yeah. Why don't you just wait until the end of the year? Because at the end of the year, you know what your cost is going to be, right? Why don't you just wait 12 months?
Because customers need it sooner. I mean, you got to give a quote to somebody. You probably want to make sure you know that those costs are ahead of time.
Yeah, that's right. You have to estimate what the costs are. You can't just wait 12 months because you have to make decisions in the meantime about, you know, if somebody comes to you with a special order and they want to pay $10 a unit, you've been charging everyone else $15, you have to answer the question, can we make a profit if we sell it at 10? And if you don't know what the overhead rates are, at least approximately, you're not going to be able to answer that question. So on January 1st or January 2nd, you project what your cost structure is going to be using that fancy little formula. Remember that one? Y equals A plus BX. Yeah. Fixed cost plus variable cost for any level of activity. And the predetermined overhead rate is part of that equation, part of that cost structure. So it's predetermined because you use it at the beginning of the year, January 1st or 2nd, whenever you open up for business. And then you use that rate all year. Unless there's something wrong with it, you can make adjustments. You don't have to use the same rate for all 12 months. But usually it's a good idea to do that, especially if you have a seasonal business. What would be an example of a seasonal business? What?
Some constructions.
Yeah, construction. Yeah, if you live in the north where they have a lot of snow, most construction goes on in the summer, the spring and the fall before the snow falls. Less construction in the winter. They might structure things so they do the outside stuff before the snow, and then if they can put a roof on a house, they'll do the inside construction when it's snowing out, if it's a building. Some kind of construction you can't do. You know, the ground gets too hard or something, even with machinery. So you could have, the good months might be the second and third quarter of the year. If you have a ski resort, it might be the fourth quarter and the first quarter of the next year, mostly the first quarter. If you have a summer resort, it may be the summer months. So you could have peaks and valleys in your revenue stream. And if you had quarterly predetermined overhead rates, you could sort of mess up your decision-making process because your unit cost would change a lot. You know, what if you have some kind of a resort that's open mostly during the summer months, you're going to have a lot of business, so you can spread that overhead rate over more units. Let's say that your business in the summer drops by 80%. It's a big difference when you're spreading that overhead rate over 20 units instead of 100 units. And so, especially if you have a seasonal business, you want to determine your predetermined overhead rates on an annual basis, not on a quarterly basis. Were there any homework problems that pointed that out? You've done the homework, right?
For this week?
Yeah, for this week. There weren't any? There weren't any homework problems that pointed out the errors of quarterly predetermined overhead rates? I'm just testing you now. Yeah, there was one. I forget which one it was, but it's in there somewhere. We'll go over it as time allows. But I just mentioned that here so that when we go over it, if we have time, it'll be a review, not something that's totally new. And we'll see how that works. So again, why use an allocation base? You have to be able to predict what your cost structure is going to be, what your unit cost is, and so forth. An allocation base, such as direct labor hours, direct labor dollars, which is a different thing, or machine hours, is used to assign manufacturing overhead to products. So the question is, which of those bases do you choose? These are called cost drivers, by the way. What causes the cost to come into existence? If you have an assembly plant where you use lots of labor, would you use direct machine hours or direct labor? Or machine hours or direct, machine hours or labor hours? If it's an assembly plant. Machine hours? You don't have machines. It's an assembly plant where they put stuff together with their hands. Labor hours, right? You see where I'm going with this, right? Yeah. If you have an assembly plant, there are a lot of people assembling stuff. And so probably labor hours would be the cost driver that you want to use. What if, like my father-in-law used to work in a steel plant, and he worked the midnight shift. There were only 3 people in the whole plant, and they pushed buttons on machines, and things moved from point A to point B. Millions of dollars worth of machinery, only 3 people running the place. If you were trying to allocate overhead, would you use direct labor or machine hours? Machine hours, right. So which of these you choose, whether it's labor or machine hours, and those are 2 possibilities, they would be heavily dependent on what kind of an operation you're running. If it's an assembly thing with lots of people, maybe labor hours would be better than machine hours. If it's mostly machines that you're using, machine hours would be better than labor hours. So we use an allocation base because it is impossible or difficult to trace overhead costs to particular jobs. If the cost of tracing something exceeds the benefit, then you don't trace it, you just allocate it. And we're going to allocate some things tonight. Part B, manufacturing overhead consists of many different items, ranging from the grease used in machines to the production manager's salary. Again, these are things that it just doesn't make sense to trace them directly, but we can allocate them. If the manager spends 20% of his time on a particular product line, you might allocate 20% of that salary to that particular product. That's how you do that. You wouldn't trace it, though. You would just allocate it. Part C, many types of manufacturing overhead costs are fixed even though output fluctuates during the period. Like the rent. If you rent a building, you're going to pay the same amount of rent regardless of how many units you produce for any given month or quarter. Manufacturing overhead application, the predetermined overhead rate, POHR, predetermined overhead rate, used to apply overhead to jobs is determined before the period begins in January if you have a calendar year. Do all companies have a calendar year?
No.
Meaning it begins January through December. That's a calendar year? No. Yeah, fiscal year would be any year that starts in a month other than January, basically. Yeah. Then there's another kind too. What's the third kind? We have, yeah, calendar year starts January 1st. Fiscal year is the first day of any month except January. Then the other one begins with F. IF. T. 52, 53 week year end. No? Remember that? It's like a minor kind of thing. But a lot of retailers have that for management accounting purposes, where it might start the first Monday in February or the second Tuesday in March. Probably not the second Tuesday in March, but it could. And the reason they do that is so that they can split the year into approximately 4 periods of 13 weeks each, so that they can compare first quarter this year versus first quarter last year, that kind of thing for management accounting. Again, we'll get into that a little bit here, not so much, well, not at all in chapter 4, but I just mentioned that. And so, again, you have to get these numbers toward the beginning of the year. Here's how you estimate it. It's estimated total manufacturing overhead cost for the coming period. You make a wild guess at what that cost is going to be. Well, it doesn't have to be too wild. Then you divide it by the estimated total units in the allocation base, whatever that is, if it's direct machine hours or labor hours, whatever that happens to be. And then that would be your predetermined overhead rate. Then you multiply that by whatever the volume of activity is. So in that equation, y equals a plus bx. Y is the total, a is the fixed, and the b and the x would be this number plus the level of activity. Ideally, the allocation base is a cost driver that causes overhead, like labor hours, for instance. If it's an assembly plant, the more stuff you crank out, the more hands are going to be needed to assemble that stuff for more hours. If it's something that involves a lot of machine time, the more volume you have, the more machine hours you're going to use. So there should be some kind of a cost relationship there, or a direct relationship between the level of activity and the cost. The need for a predetermined overhead rate makes it possible to estimate total job costs sooner. You can do it right there. You don't have to wait until December 31st and then look back to see what your actual costs were. Do we ever do that, though? Like in December or January of the next year, do we look back at the costs and then compare them to what our estimates were?
Yeah.
Yeah, we do that. That's a good management control technique, right? Remember in the first chapter it said management accounting is about planning and control? This would be a control feature. You compare the actual cost to what you thought they were going to be based on your estimates. And then if they were different, they always are, you have to ask yourself the question, why were they different? Yeah, figure out why your estimate was off, and then fine-tune it a little bit so that this year the estimate's going to be closer. So that's part of the control function of planning and control. Planning would be figuring out what this predetermined overhead rate would be. Control would be looking back to see how close the estimate came to. Actual overhead for the period is not known until the end of the period. You don't know what the actual costs are until later. But that's okay. We have to deal with incomplete information and sometimes conflicting information. Computing predetermined overhead rates. It's computed before the period. They have a 4-step process. Estimate the total amount of the allocation base. That's the denominator. How many labor hours do you think we're going to use, or how many machine hours do you think we're going to need? And number 2, estimate the total fixed manufacturing overhead. Well, last year, if manufacturing overhead was 40 million, maybe this year it's going to be 41 if it goes up by 2.5%. And again, you could maybe make some calculations. You know, if the rent's going to go up, that would be an overhead item. If certain other items are going to go up or remain unchanged, those would all go into it. You can start off with an estimate that this year is going to be about the same as next year, and then you look at the changes and you fine-tune it a little bit. Number 3, the third step, is to use a cost formula to estimate the total manufacturing overhead cost. Some is fixed, some is variable, and compute the predetermined overhead rate. And that's it. That's the 4-step process. And applying overhead cost to jobs using that rate. Here's an example. Pear Company estimates that it will require 160,000 direct labor hours to meet the coming period's estimated production level. In addition, the company estimates total fixed manufacturing overhead at $200,000 and variable manufacturing overhead cost at $2.75 per direct labor hour. All that stuff's already been determined and computed. Doesn't this scream for an equation, y equals a plus bx? Yeah, it does. Oh, there it is. Yeah, just plug it in. Fixed cost is $200,000. That's A, plus $2.75 per direct labor hour multiplied by the number of labor hours you think you're going to use, 160,000 in this case. Again, it's based on an estimate. As of January, you don't know how many it's going to actually be. Well, you also don't know that it's going to be $2.75. That's an estimate. And you also don't know that fixed is going to be 200. So we have three estimates in this equation. So what's the probability that Y is going to be correct? Almost zero, right? Yeah, but that's okay. If it's close, how close is good enough? If it's within 5%, is that close? How about if it's within 20%? Maybe not. Nobody can agree on what's close. If it's within 1/10 of 1%, I think that's really, really good. 5% may be good. Depends on the industry. Different industries have a different cost structure. They have different things going on. If it's more volatile and you come within 5%, that might be pretty good. If it's in a stable industry and you're off by 5%, maybe somebody's going to get fired. This one company I used to work for, someone was off by $1 million in a company that had, this is tax liability, where he figured something out like this, and he got fired. I didn't like the guy anyway. He's my boss. That's the 70s were not a good decade for me. I can remember them, but I had 3 bad bosses all in a row. That's not going to be on the CPA exam, so I don't have to talk about it. Okay, so anyway, the predetermined overhead rate. If you think your estimated total manufacturing overhead is going to be 640,000, and if you think that your direct labor hours are going to be 160,000, you just divide the dollars by the quantity figure, and you get $4. So the predetermined overhead rate is $4. So in that equation, y equals a plus bx, the $4 would be part of that, and then whatever the volume of activity is would be the other part. Compute the total cost and average cost per unit. Here we have some numbers. Again, the direct material cost is 116, direct labor 88, manufacturing overhead is 32. So the total cost is 236. And then for the units, if they tell us what the units are, how many units, we can divide that. And they do tell us the unit product cost, I guess, is 2, right? No. Unit product cost is 118. 236 divided by something is 118. So it must be 2 per unit.
Units completed. Units completed. Is that what you're looking for?
Yeah, units completed. Yeah, 2. Yeah, 236 divided by 2 is 118. Units completed. It gets a little more difficult if you have some units that are partially complete. Now, let's say that you have something that takes a while to manufacture. You don't just start it at 9 o'clock and you end by 4 and everything is done. Let's say it may take you 2 months to finish something, and now it's November 30th. You're not going to be finished with this. If you start November 30th and it takes 2 months to complete, you're not going to be done till the end of January. So you're going to have some parts, some product that's maybe 40 or 50 or 60% complete. Those are called equivalent units. You have to sort of factor those in to the formula to figure out what the unit cost is when you have partially completed stuff. You'll notice in these examples in Chapter 4, they don't really have work in process inventory. We have 3 kinds of inventory, right? Raw materials inventory. It's stuff that you just bring in before you start doing anything to it, before you put it in process. Raw materials inventory. And then when it's in process, but not completed yet, we have, it's called work in process inventory, or some companies call it work in process, work in progress. Different textbooks call it different things. And then when it's finished, it's called finished goods inventory. So if you have a manufacturing operation, you really have 3 kinds of inventory. Raw materials, like if you make steel. If you make steel, you're going to have iron ore, coal, coke, some other stuff. You're going to have that stuff piled up somewhere, tons and tons of the stuff. That's all raw material. Once you start taking it from those piles and you put it into a furnace and you heat it up and do other things, then you have something that's in process, like a steel ingot or something. before it's made into something else. That would be a work in process inventory. And if you don't sell all that stuff and ship it out by December 31st, you're going to have some finished goods inventory and you're going to have some work in process inventory, as well as raw materials. So you could have 3 different kinds of inventory. All 3 of those are discussed in this chapter a little bit. Here's a quick check. Job WR53 at NW Fab Inc. Required $200 of direct materials and 10 direct labor hours at $15 per hour. Don't you have the urge to multiply that 10 by 15? Or is that just me? 10 times 15, 150. Don't you get the urge to do that and then add it to the 200? So that's 350. Oh, that's answer B, right? 200 plus 10 times 15 is 350. So that's answer B. Estimated total overhead for the year was $760,000 and estimated direct labor hours were 20,000. What do you get the urge to do there? Divide. 760,000 divided by 20,000. If we just chop off 4 zeros, it's 76 divided by 2. That's like 38, right? 38 and a 0. 38 and a 0. Yes? No? Yeah. Yeah, okay. If we multiply it by 10 direct labor hours, 38 times 10 is 380. That's answer C. Oh, these authors, only one of those answers is correct. What if we add B and C? 350 plus 380, that's 730. There's a good answer for all of these, right? And then, of course, the 200 was given to us. So A, B, C, and D, we can see where all of them came from. So we have to be very careful to see what question they're asking. This question is, what would be recorded as the cost of job, WR53? Well, the cost would be direct material plus direct labor plus factory overhead. So which number do you think it would be? Would it be the smallest one or the largest one or something in between? Well, direct materials, 200. Direct labor is 150, so that's 350. So we know it's not going to be A. And it's not going to be B either because it doesn't include overhead. So it's got to be C or D. And we know 760 divided by 20,000 is another 38. Well, that's per unit times 10 is 380. So can we agree that the answer is D? Well, I hope it's right, because otherwise I don't know what I'm going to say. Oh, there it is, 730. Okay. And you see where it came from. The POHR, 760 divided by 20, that's 38. Direct materials, 200, that was given. Direct labor, we could figure that out. 15 times 10 is 150. Manufacturing overhead, we figured that out, was 38 per unit times 10 because there were 10 hours involved. So we add that up, that's 730. So the correct answer is D. Good exam question?
Yeah.
Yeah?
For now.
Yeah, for now. Yeah. Usually the first one is the easiest. So guy changed the name of the company?
Yeah.
Yeah, okay.
And leave all the-
Leave all the numbers the same though, right? Just change the name of the company. Okay. Actually, I take all these questions from my secret professor source. Key definitions, raw material include any materials that go into the final product. Work in process consists of the stuff that isn't finished yet. I'm ad-libbing here a little. Finished goods consist of the stuff that is finished. And the cost of goods manufactured include the manufacturing costs associated with the goods that were finished during the period. I remember I said before, you might have some stuff that's partway, 40, 50, 60% complete now. You're not going to finish it until next year. You could have some stuff from last year that was, let's say, 60% finished last year, and you finished the other 40% this year. And so you had a work in process inventory from last year that now becomes part of finished goods inventory this year. And you can have some stuff that you started in production this year and finished this year. That would be part of finished goods. You can have some other stuff that you started in production this year, but you're not going to finish until next year. And so you have some finished goods, some stuff that's still in process. So again, you have 3 kinds of inventory: the raw materials, What's the other one? Begins with W. Work in process and finished goods. Now, the stuff that's finished during the period is the cost of goods manufactured. What's the difference between cost of goods manufactured and cost of goods sold?
Okay, you have produced, one is produced, like, and then the other one is already sold. It's produced and sold. Like you gain revenue.
Yeah,
I mean,
yeah, the stuff that's sold represents what went out the door, or what was sold, which is almost the same as what goes out the door. Remember from your financial accounting class, when do you determine when a sale is made? Is it when you ship it out? Is it when you enter into an agreement? When is it? Remember all that stuff?
when it's shipped out.
Usually when it's shipped out. Yeah, when the earnings process is substantially complete. Usually that's when it's shipped out. So in this case, you have some stuff that's finished that hasn't been sold. You have some stuff that's finished and has been sold and it was shipped out. Then you have some stuff that's in process that isn't saleable yet because it isn't finished.
Is it because it becomes part of your debit, like account receivable, although you haven't received the money yet?
Yeah, some of that could be accounts receivable. Let's say that you sell it, but you don't get paid for 30 or 60 days. That would be the revenue end. Remember, sometimes in financial accounting, you make 2 journal entries for one sale, one to record the sale. That was a debit to either accounts receivable or cash, and a credit to sales. And then the other one would be the cost of sales, where you debit cost of goods sold, and what would you credit? Begins with I, N. Inventory, yeah. So we're going to have some of that this time. There aren't too many journal entries in this course. Sorry. I know you love journal entries, right?
No.
Not so much? Yeah, well, yeah, yes. Okay. The curve breaker over there. She likes cost accounting. She likes journal entries. We have a curve breaker in here, folks.
Well, I feel like the journal entries could help us visualize if we saw these inventory accounts as T accounts, because I'm imagining at least that the raw inventory is a T account, the work in progress is a T account, and you start debiting and crediting each one, you can kind of see the process flows.
Yeah.
Maybe that's wrong, I don't know.
Yeah. Now, in the old days, when I used chalk, you've heard about chalk? Maybe you've even seen some. I used to inhale it when I was putting it on the board. I don't know what long-term effects that's going to have. I used to be able to draw these T accounts across the board. There's only 4 of them really that are affected here. You have a T account for raw materials inventory, a T account for work in process, another one for finished goods, then another one for cost of goods sold. In fact, if you want to, you can take a few seconds and draw those 4 T accounts. First one is raw materials inventory. You remember T accounts? Was that like 5, 10, 20 years ago for some of you? Okay, sorry about that. T accounts. The reason they call it a T account, it looks like a T. Yeah, and on the left side, that's the debit side. So the first thing you would do, you would have a beginning balance. Let's say for raw materials, that would be the T account on the left. We're going left to right. Raw materials inventory, T account. You'll have a beginning balance and an ending balance. You'll have another debit. Every time you make a purchase, you're going to debit the raw materials inventory, and you're going to credit either cash or accounts payable. And then when you take it out of raw materials and you start processing it, you credit the raw materials inventory and you debit that second T account, work in process inventory. Work in process inventory is the second T account that's involved. I'll give you time to write that down in case you've got it, right? Yeah. Yeah. In case I can't make it some Wednesday, maybe you can come and sort of explain it to the class, no? Okay. Just looking for a way to not come to class 1 week. So anyway, the second T account is work in process. You're going to have a beginning and ending balance in that work in process T account as well, the second T account. The debits to that T account will come from the first T account. When you credit raw materials inventory, the offsetting debit goes into work in process. Now there are 3 other debits that go in work in process. One would be direct materials, one would be direct labor, and the other one would be overhead, which could consist of indirect materials and indirect labor. Those are other debits. The credit to that second account, work in process, is when it's no longer in process. When it's no longer in process, it's finished. So you would credit work in process inventory. What account would you debit? Begins with F. Finished goods inventory. That would be the third T account. And so you're going to have a beginning and ending balance for finished goods. The other debit you're going to have for finished goods would be the transfer from work in process. Work in process is credited, and the debit goes to finished goods. Why would you credit the finished goods inventory? What would have to happen in order for you to credit the finished goods inventory?
You have to sell it.
You have to sell it. Yeah, and when you sell it, it becomes part of cost of goods sold. And so the credit goes to finished goods to reduce finished goods. The debit goes to the cost of goods sold T account. So you have 4 of them again: raw materials, work in process, finished goods, cost of goods sold. And those are all the journal entries, pretty much. Well, I left a little out. What did I leave out? Well, a lot of that's made based on predetermined overhead rates, right? Estimates. At the end of the year, you'll know what the actual numbers are. When you know what the actual numbers are, you're going to have to make an adjustment to cost of goods sold. The difference between your estimate and the actual number, the cost of goods sold number, the ending balance for cost of goods sold has to be based on actual costs. You don't know what they are till the end, but you have a balance in there already. What do? Well, the difference between the number you have and the correct number is going to have to be either a debit or a credit to cost of goods sold. And the other half of that entry is going to be an adjustment to, depending on how you set up your books, it could be retained earnings, or it could be income summary. Depends on what textbook you used. You remember that? It's starting to come back a little bit, maybe. And if you took it 10 or 15 years ago, it's probably vanished. But in the interest of completeness, I thought I'd mention that. Again, there aren't too many T accounts in this class, but just the nice thing about journal entries is it shows you how things flow. And T accounts, even better. T accounts are like photographs in time, sort of. Flow of costs, again, material purchases. When you buy something, you would debit material and credit either cash or accounts payable. It's not in this chapter. I'm just trying to sort of refresh your memory a little bit. Direct labor, when you pay for wages and salaries expense might be the debit, and either cash or salaries payable would be the credit. Manufacturing overhead, that's all that indirect stuff. Selling and administrative, those are costs, but they're not part of the manufacturing process. For balance sheets, inventories, again, if you have a manufacturing operation, you have 3 kinds of inventory: raw materials, work in process, and finished goods. And the income statement stuff has expenses, cost of goods sold, and selling and administrative. Which of those is a period cost? Which of these is a period cost? Cost of goods sold or selling and administrative?
Selling and administrative.
Yeah, selling and administrative.
Oh,
What?
We have here comes down both of them, so.
Well, this has period cost by both of them, but why is that? Why does this say period cost and that also say period cost? Is there a mistake someplace? Yeah, there is. Where's the mistake? It's either here or there, last line or next to the last line. Which is the mistake? Yeah, the next to the last line. Because cost of goods sold is not a period cost. Again, a period cost is deducted at the end of the period. The product cost is deducted when the product is sold. So there's a mistake on this slide for cost of goods sold. It should not say period cost. It should say product cost. And you looked at these slides before class, so you knew that, right? And the reason you didn't raise your hand and say there's a mistake here is you were trying to be polite so someone else could get the credit. Got it. Okay. I think last week we found 3 mistakes, right? This week we found 1 so far. Yeah. Here's an extended example. Rand Company. At the beginning of April, there was no finished goods inventory. That's good news, right? Makes our job easier. Job A, a special minting of 1,000 gold medallions, was the only job in process. Job A's cost sheet included $30,000 in manufacturing costs that were recorded in a prior period. So they're still hanging around there. Would that 30,000, would that be a product cost or a period cost? The 30,000 manufacturing cost, would that be a period cost or a product cost?
Oh, that's, product cost.
Product cost, right, because it's a manufacturing cost. All manufacturing costs are product costs. That means you don't deduct them until the product is sold. So these costs are just sitting around waiting for that product to be sold. They were not deducted at the end of the last period. Job A will be completed in April. Job B, in order for 10,000 silver medallions, will be the only job started in April, and it will be completed in a subsequent month. So it looks like there's going to be some work in process there. Given this information, we will now track the flow of Rand Company's raw materials, direct labor, and overhead costs for April and prepare an income statement for the month. So we have things like factory utilities, heat, power, and all that stuff, 21,000. What kind of cost would that be? Direct material, direct labor, or factory overhead? The first one, the 21,000?
Overhead.
Yeah, that's factory overhead, yeah. How about rent on factory equipment? What's that? Factory overhead. Factory property taxes? That's
Overhead.
factory overhead. Factory insurance?
Or
Factory overhead. You see a pattern here, right? Manufacturing depreciation is factory overhead. Miscellaneous factory overhead costs are miscellaneous. That's as indirect as it gets. So the total manufacturing overhead incurred 78,000. We still have direct material and direct labor. This is the factory overhead component. But we have two other components that we're going to have to deal with at some point. I don't know why they have that roulette reel in there. It's a nice multicolored thing, but okay. Oh, here we have something that this almost looks like T accounts. You can see the cost flow anyway. So notice how this is structured. On the left side, you have job A. You have a beginning balance. They told us there was 30,000 in there. Direct materials are 28. The direct labor, which comes from here, job A, 40,000. Job B, they didn't have a beginning balance for job B. Direct materials are 22,000. Direct labor for job B was 20,000. And here, manufacturing overhead incurred. You had indirect materials of 2, indirect labor of 15. Total here 75, which is allocated like that. And so what do we have here? We have total manufacturing costs of 78,000. That's for manufacturing overhead. And the manufacturing overhead that's applied to the various jobs. For job A, $6 per machine hour times 10,000 machine hours, 60,000. And for job B, $6 per machine hour times 5,000 machine hours, 30,000. So the total here is 90. And it's allocated 60,000 for job A, 30,000 for job B. But you'll notice the overhead incurred was 78,000. We thought it was going to be 90, but it was 78. What do we do with that? Yeah, it means, yeah, this is applied. Another word for applied means estimated in chapter 4 anyway, right? When you see applied in chapter 4, they mean estimated. So the estimated cost is 90, but here we have the actual cost, manufacturing overhead incurred. Incurred means these are the actual costs. So the total manufacturing cost, well, overhead cost, 90, 95. Overhead incurred 78. And then these other things, these are also manufacturing overhead. We have the 3 categories. And so where there's a difference, we're going to have to make an adjustment. But again, you have to go with the estimated because you don't know what the actual is until the end of the accounting period.
How did you get 95? It's 95,000.
The 95 is in some of these things. Yeah, indirect materials, that's the kind, any kind of indirect manufacturing cost is overhead. And so indirect materials and indirect labor, because they're indirect, those would both be overhead. But you have this other stuff, that other 78,000, that doesn't have anything to do with materials or labor necessarily, just, you know, could be depreciation, for instance, things like that. They're not direct material, they're not direct labor, or indirect rather, but they're other indirect costs. And so the 95 is just the sum of these three categories. So you're almost always going to have a difference between estimated and actual because you're working with incomplete information. Some of your costs may shift a little bit. You know, something was $4 a unit before, maybe next year it's going to be $4.03 or $3.96. Something. So you don't know until the end of the period when you look back to see what your actual costs are. So the next thing is to compute the underapplied or overapplied overhead. Now, when I was taking this course, like 100 years ago, those terms were confusing to me, underapplied and overapplied. Is there another term we can use, maybe a synonym? A synonym means something that means about the same thing, right? What could we call that instead of underapplied? Underestimated, exactly. Yeah. Underapplied, underestimated. How about overapplied? What would we call that? Overestimated. Okay. If you can just think of it that way, you won't get confused. Underapplied, underestimated. Overapplied, overestimated. The difference between the manufacturing overhead cost applied or estimated to jobs and the actual manufacturing overhead costs of a period is called the underapplied, meaning underestimated, or overapplied, overestimated overhead. Number one, underapplied overhead exists when the amount of overhead applied to production is less than the actual manufacturing overhead costs. And the second one, overapplied overhead exists when the amount of overhead applied to production is greater than the actual manufacturing overhead costs. In other words, overestimated. So recall the following facts. Number one, actual manufacturing overhead was $95,000. Number two, total manufacturing overhead applied or estimated for production was $90,000. So there's a $5 difference. The actual cost was $95,000. The estimated cost was $90,000. Therefore, the company's overhead is underapplied or underestimated by $5,000. How would that affect gross margin? Gross margin is the same as gross profit, right? Now you have sales minus cost of goods sold equals gross profit or gross margin. How would that affect gross profit or gross margin? If the company's overhead is underestimated by 5, yeah, it means you have to subtract 5,000 more. If you subtract 5,000 more, that gross profit shrinks by 5,000. Yeah, so that's the relationship. And then the bottom line, net income would shrink by some number as well. Not necessarily 5,000 because it's after tax and all that. Okay, so anyway, that's the relationship. If you underestimate and it's a cost, it means you have to add more cost. If you add more cost, the next line shrinks, right? Whatever that revenue line is. So here's a quick check. Tiger Inc. had actual manufacturing overhead cost of $1,210,000 and a predetermined overhead rate, or an estimate of $4 per machine hour. Tiger Inc. worked 290,000 machine hours during the period. Tiger's manufacturing overhead is, what do you get the urge to do with those numbers? Multiply $4 times 290,000, and then subtract that from 1,210,000. Okay, yeah, we have 3 numbers to work with. We can use all 3 of them here. Sometimes they'll give you numbers that you don't use just to tease you a little bit. But this time we're going to use all of them. They had actual manufacturing overhead costs of $1,210,000, and the predetermined overhead rate is $4 times 290. And so you have $4 times 290, that's $1,160,000. And the difference between that and the $1,210,000 is $50,000. It was underapplied, which means underestimated. How would that affect gross profit? Would gross profit be too high or too low? Yeah, gross profit. How would gross profit be affected by this? They underestimated overhead by 50,000. Yeah, it would have to be reduced then, right? Because you have to add that 50,000 to cost of goods sold. that would shrink gross profit by 50,000. You have to deduct an additional 50,000. So any difference between the manufacturing overhead incurred and manufacturing overhead applied, such as Rand's 5,000 of underapplied overhead, again, the difference between the 5,000, or I mean the 90 and the 95, going back to that example. What do you do with that 5,000? There's two ways you can deal with that 5,000. Which way did the author say we're going to use in this course? Did you say we're going to take it directly into cost of goods sold? I think that's what I heard you say. I think she's, yeah, she just said that we're going to take the whole thing into or out of cost of goods sold, right? Yes, exactly. Because there's another way you can do it. Because we have those 3 T accounts, remember the other ones besides raw material? You have work in process, finished goods, cost of goods sold. The argument could be made that you should spread that difference, the 5,000 or the 50,000, whatever it happens to be, spread those among those last 3 T accounts. Again, the first one was raw materials, leave that one alone. Work in process, finished goods, cost of goods sold. If we spread that difference, that incorrect estimate, over those 3, that would be a better matching. Remember matching from your financial accounting class? You match revenues or expenses with the period of expected benefit, blah, blah, blah. That would actually be the better way, theoretically, where you split that 5,000 or 50,000, whatever it is, among those last 3. Work in process, finished goods, cost of goods sold. We're not going to do that this semester because the author said they're not going to do that. They're going to just throw the whole thing into cost of goods sold or take the whole thing out of cost of goods sold. Why are they doing that? To make our life easier. Now, to keep in mind, there's 2 ways you can do it. We can just make the total adjustment, 100% of the adjustment, 5,000 in this case, take it into cost of goods sold, take it out of cost of goods sold. All of it is in or out of cost of goods sold. That's the easier of the 2 ways. Theoretically, it's not quite as good. There's this other accounting rule, going back to financial accounting. It has to do with materiality. Remember that one? Materiality? No? Materiality means you only have to follow generally accepted accounting principles for material items. If it's an immaterial item, you don't have to follow generally accepted accounting principles. In fact, part of generally accepted accounting principles is that it only applies to material items. You probably want an example, right?
Sure.
Oh, okay. Since you asked. Yeah, you've heard of craftsmen. They make hammers and stuff. Tools, they make tools. Craftsman hammers, they sell them at Sears. Sears hasn't completely gone out of business. Sears, Roebuck and Company. Nice thing about buying a Craftsman hammer, it has an unlimited useful life. If you break it, you can take it back to Sears. They'll give you a new one, no cost. When you're depreciating a Craftsman hammer, over how many years should you depreciate it? The infinity, I guess, or until Sears runs out of business, goes out of business, you know, whatever comes first. Now, the point is, Craftsman hammers, $10, $20, whatever they cost, that meets the definition of an asset because it has economic value beyond the balance sheet date. You're still going to have an asset after December 31st. So a hammer is an asset. For accounting purposes, since it's only $10 or $20, we can pretend it's an expense. We can write off the whole cost of that hammer in the year we purchase it because it's an immaterial item. It meets the definition of an asset because it has value beyond the balance sheet date. We can treat it like an expense because it's an immaterial item. 10 or 20 bucks, just write it off. The cost of depreciating that thing every year exceeds the benefit. Let's just deduct the whole $20 this year. That's an immaterial amount. Relating that to chapter 4, this, what do we do with cost of goods sold? Even though, theoretically, the best way to do it, the better way to do it, because there are 2 options, is to spread it among those last 3 T accounts, work in process, finished goods, cost of goods sold. That's the better of the 2 ways because it complies with the matching concept. If it's an immaterial amount, why not just throw the whole thing into cost of goods sold? It's easier. We don't have to deal with that allocation. And it doesn't make much difference because it's an immaterial amount. If it's an immaterial amount, we can do that. If it's not an immaterial amount, it's like two negatives, then we should spread it. For purposes of this course, it's always going to be an immaterial amount because the authors say so. Got it? I'm trying to inject a little theory here and take you back to financial accounting because these concepts do tie in with each other. If you haven't had financial accounting for 5 or 20 years, this will be a review. Well, it's a review anyway, I guess. Maybe triggering your memory banks. So anyway, disposition is, it's a fancy way of saying what are we going to do with this difference. Disposition of underapplied or overapplied overhead balances, we already discussed it. We will always assume that underapplied or overapplied overhead is closed out the cost of goods sold because the authors say so. Number one, overapplied, meaning overestimated overhead, is deducted from cost of goods sold. You know, if you thought cost of goods sold was going to be 100,000 and it was really 95,000, you've overestimated. 95,000 is the number that has to go in the income statement. It's 100,000 now because you overestimated. You have to take that out. So overapplied overhead is deducted from cost of goods sold. You have to take it out. Number two, underapplied or underestimated overhead is added. You didn't estimate enough. If you thought it was going to be 95,000 and it was really 100,000, you have to put another 5,000 into cost of goods sold. That would be added to cost of goods sold. And if it's added to cost of goods sold, what happens to gross profit? Increase or decrease? Begins with D. It decreases because you're subtracting an extra 5,000 in cost of goods sold, or whatever the number happens to be.
Don't we add that? So like say you earned $5,000 in cost of goods sold.
Mm-hmm.
Aren't the goods already sold? So how do you recuperate that? Or you just take it at this point, you just take the loss?
Yeah. The question was the goods are already sold, so why bother doing that? Well, it's because your estimate was off. You know, if you deducted 95,000 for cost of goods sold when it was sold, and it should have been 100,000, you have to make that adjustment.
So you're not recuperating it by selling products. You're literally just taking it out.
Yeah, you're just making an adjusting entry. Yeah. When you sell stuff, remember, there's maybe two entries. I say maybe because it depends on what kind of accounting system you use. But you you debit cost of goods sold and you credit inventory. If originally you debited 95,000 for cost of goods sold, credited 95,000 for inventory, but it should have been 100,000, then you just make an adjusting entry for the other 5. Yeah. You have to bring the number up to or down to whatever the actual cost is. But you don't know what the actual cost is till December or maybe January of the next year. Then you make the adjustments before the books are closed. Remember that, closing entries? This would be like an adjusting entry before you close. Quick check. Recall that Tiger Inc. had $50,000 underapplied, meaning underestimated, manufacturing overhead. The disposition of this overhead will A, increase cost of goods sold, B, decrease cost of goods sold, and C, have no impact on cost of goods sold. What do you think? If they underestimated, what effect? A, it'll increase because they underestimated. They have to add 50,000 to that. So the answer is A. If they underestimated, it means they have to add something to cost of goods sold. Use the direct method to determine cost of goods sold. What's the other method? Indirect. See how easy this is? Which method do you like better? How many like the direct method better? Show of hands. Nobody? How many like the indirect method better? Show of hands. 1. Now you notice who raised their hand. The one who knows what's going on in this class. I mean, you all know, but some people know. No. She likes the indirect method better. Well, let's take a look at the direct method to see what that's all about. The direct method to determine cost of goods sold. Job A, which consisted of 1,000 gold medallions, was completed during April. The job B was not completed, so there was some work in process inventory there. The unit product cost for each of the 1,000 gold medallions included in job A was $158. 158,000 divided by 1,000 units. The overhead for April was underapplied or underestimated by 5,000. Let's assume that 750 of the 1,000 gold medallions included in Job A were shipped to customers by the end of April. The cost of the medallions sold to customers would be 118,500. That's 750 times 158 per unit. What happens to the 250 that were not sold? Where does that number show up? Yeah, that would be in May if they sold them. It would be in the ending inventory for April, right? Because it's a product cost, you don't deduct it until the product is sold. So that other 250 times 158 would be part of ending inventory for the current month. And again, I guess that's an accountant explaining everything to management. I don't know. So for the direct method, the unadjusted cost of goods sold, we thought it was 158 per unit. So we used that times 750. And then for the underapplied or underestimated, we'd have to add that because the cost we estimated was too low. We have to come up with the actual cost. At the end of the period, we know what the actual cost is. It should be 123,500. And so we just add that to the 118,500, which was our estimate. That's the direct method. Using the indirect method, and again, if you have time, you should use both, the direct and indirect, see if you get the same answer. It's a way to check your work. If you don't have time to do both, do the one you feel more comfortable with. The beginning work in process inventory was 30,000. The beginning balance in Job A's cost sheet. There was no beginning finished goods inventory on April 1st. The total manufacturing cost charge. Charge in accounting means debit, but we're not doing journal entries in this chapter, but charge means debit. The jobs in April was 200,000. Direct materials of 50,000, direct labor 60,000, manufacturing overhead of 90,000. You add that together, it's 200,000. The ending work in process inventory is 72,000. The accumulated cost of Job B. Manufacturing overhead was underapplied by 5,000. Since Job A consisted of 1,000 medallions and 750 of those units were sold by the end of April, the ending finished goods inventory consists of 250 units. They had 1,000, they sold 750, which means they did not sell 250. Since the unit product cost of Job A is $158 per unit, the total cost of the 250 unsold but completed units is $39,500. That's the 250 that were unsold multiplied by the estimated unit cost of 158. So you have sales of 225,000 minus the cost of goods sold, 123,500, leaving you with a gross margin of 101,500. So the formula for computing the cost of goods manufactured is shown on this slide. Cost of goods manufactured equals total manufacturing cost charged to jobs plus the beginning work in process inventory minus the ending work in process inventory. So I asked this question before. Let me ask it again. What's the difference between the cost of goods manufactured and the cost of goods sold? The finished goods inventory, right? You have the three kinds: raw materials, work in process, finished goods. This one includes the first two kinds, raw materials and work in process. If you have the cost of goods manufactured and you want the cost of goods sold, you take the cost of goods manufactured, this one, you add the beginning finished goods inventory, and you subtract the ending finished goods inventory. That will give you the cost of goods sold. So that's the difference. It's the finished goods inventory. Cost of goods manufactured plus the beginning balance of finished goods inventory minus the ending balance of finished goods inventory. That'll give you cost of goods sold. That's the only difference between the two. The finished goods inventory, the change in the balance. So we have manufacturing cost charged to jobs, direct materials 50, direct labor 60. manufacturing overhead applied or estimated, 90. So the total manufacturing costs that were charged, 200,000. Then you add the beginning work in process of 30,000. That brings it up to 230. And then you deduct the ending work in process, 72. That's 158,000. So if you had 1,000 units, 158,000 divided by 1,000 is 158. That would be your unit cost. But again, that's based on estimated numbers. I don't know what that's for. It's a nice color thing there. There's another one. You know what those are, right? Pencils. Accountants used to use those in the old days. You've maybe seen them around. So the cost of goods sold equals the beginning finished goods inventory plus the cost of goods manufactured, which we just computed, minus the ending finished goods inventory. So again, the only difference between cost of goods manufactured and cost of goods sold is the finished goods inventory. You add the beginning balance, subtract the ending balance. So we didn't have any beginning finished goods inventory in this example. So then you add the cost of goods manufactured, which we computed before. That gives you something called cost of goods available for sale. If you sold everything you had that was finished, the cost of that would be 158,000, cost of goods available. But you didn't sell everything because you had 250 medallions left. The finished goods inventory for those 250 medallions was 39,500. So you subtract that. So the unadjusted cost of goods sold, because this is based on estimated numbers, 118,005. But we know that the cost of goods sold should be 123,005 because our estimate was off. So we have to add that other 5 because it was underestimated, underapplied. So that's the indirect method. The nice thing about the indirect method is that it shows everything. The nice thing about the direct method, you can do it in like 4 or 5 lines. So yeah, they each have their advantages, right? And their disadvantages. Again, if you understand both, do it both ways. If you have time, see if you get the same answer to check your work. If you don't have time to do both, do the one that you understand better, and that way you'll save more time. Oh, by the way, I've been sending out a lot of broadcast announcements lately. You've been reading them, right?
Yeah.
Yeah. I've been getting a whole bunch of emails, you know, asking questions, this, that, and the other. I now have 159 students. I used to have 161. 2 of them dropped. That happens, right? That happens. So, but so, you know, if I get 3 or 4 or 5 emails that ask the same question, I send out a broadcast announcement because I figure that's, you know, for every student that asks that question, there may be 3 or 4 or 10 who would like to ask the question but are being polite because they know I get inundated with emails. And so that's why you get these broadcast announcements. One of the announcements, some students think that 50 minutes is not enough for a quiz.
Yeah.
It's twice, 10 questions, 50 minutes, that's 5 minutes. Twice as much as what a CPA candidate would get. But I realize you're not yet CPA candidates. Another 12 to 24 months maybe, but you know. And so I've decided to up that to 60 minutes. I can't do it for the quizzes I already made, because once a student takes the quiz, there are certain adjustments I can't make anymore. But for the quizzes I haven't made yet, I'm going to boost that to 60 minutes if it's 10 questions. It'll be 6 minutes per question. And every student gets a different quiz because the software mixes things up. So some of you might get a question that takes a little longer, some a little shorter. Some of these things that don't involve numbers, you can answer in 5 or 10 seconds. You know, you read the thing and you say, oh, of course, that's B. But then other times you have to calculate things. And sometimes it won't just be a multiple choice. It'll be an exercise or a problem where there may be 2 or 3 different things you're going to have to compute. And so that takes time. And that's one reason why some of you get scores that don't end in a 0. You know, like if you get everything right, it's 100. If you get 9 out of 10, it's 90. Well, you could get 56.3 if you had a problem or an exercise that had multiple things you had to answer. So that's one reason why not every score ends in a 0. What else? Yes.
The test, the first one.
Yeah, first test.
The first, the one that's due between the 18th and the 23rd.
Right.
Okay, so how long is that gonna be and how many questions?
Okay, for the benefit of those in cyberspace, because they may not be able to hear your question, there used to be microphones hanging from the ceiling. I guess they took those out. Yeah. For the benefit of those in cyberspace, the question was asked about the exam. The first one, you can complete it anywhere in the world. I like to say, including the south of France. But the south of France isn't like it used to be. But it's still okay. You can do it, or from your home, whatever. That's going to be one of those connect things. It'll be either 20 or 25 multiple choice questions probably, and you'll get 6 minutes for each one.
Is it coming from the bank, same bank?
Probably, yeah, the same test bank. You may have some of the same questions that were on your quiz. Everybody gets a different quiz. Everybody's going to get a different exam number one, because there's a little thing I can click on so that everybody gets a different one. And it'll be scrambled. What might be A and one might be C or D and another one, plus the questions will be different.
So 2.5 minutes.
Yeah, well, 6 minutes times the number of questions.
100
So
is
if it's
160, so if it's,
if it's 20 questions, it'll be 120 minutes, 2 hours. 25 questions will be 150 minutes.
it's on. Last, I'm sorry. So it's gonna be based on the chapters that, up to the chapters that we're covering.
Yeah,
like,
let's see, what's, I think the first one, this chapter is 1 through 5, except, remember for chapter 1, there weren't any multiple choice
No.
questions.
So that's not.
So,
So 2.
yeah, so basically the questions will come from chapters 2 through 5 because there weren't any multiple choice questions for chapter 1. Does that mean you should not read chapter 1? There might be some good stuff in there, right? Theoretical stuff that'll help you understand the next 11 chapters. So read chapter 1, but the multiple choice questions are coming from chapters 2 through 5. There may be an exercise or problem in there, depending, but basically it'll be either all multiple choice or almost all multiple choice. And yeah, for those. So that's, you're welcome. And again, if you're in section 1 or if you're in section 80, either way, you get to take that. So, did I also send out a broadcast announcement saying there was not going to be class that week?
Yes.
Because, yeah.
Yeah.
I don't know if I said that here. Yeah, I said that, looking at the syllabus. There will not be a lecture this week, meaning week 6, September 20th, because you can do the exam when you should be taking the class, or some other time, because it's going to be online. The second exam, that one, you're going to have to take it in front of a live person who can watch you. Well, sort of. I say sort of because for the online students, they have 2 options. They can get a proctor through the UNC system, or they can have this thing where they have a camera on their computer and somebody watches you from cyberspace. Yeah, proctor free. For the people in section 1, just come to class. I'll be here, and I'll distribute it, and I'll watch over you. Or I'll watch you, not watch over you.
Can you do, if you're online?
Yeah, if you're an online student, you can come to class, and I'll give you the paper copy of the exam for exam 2. Yeah, exam 2 is the only one that's going to be proctored. Exam 1 and 3 will be cyberspace things. Again, the reason I chose exam 2 to be the live one, I didn't want the final exam to be a proctored exam, because if something goes wrong, there's only a few days before I have to turn in the grades, and that can create a hassle. So this way, if something goes wrong with exam 2, we have time to make corrections. That's the reason for that. It always happens. At the end of the semester, something goes wrong. If that goes wrong with 5% of my class, that's 7.3 students or something. So, okay. Well, shall we get back to this? Okay. The income statement. You remember what that looks like, right? To complete the income statement, let's assume that Rand Company's total sales revenue and selling and administrative expenses for April were $225,000 and $87,000 respectively. Ooh, that doesn't look like a contribution format, does it? That's that traditional kind of income statement you had in financial accounting, but that's okay. Sales, 225 minus cost of goods sold equals gross margin minus selling and administrative expense equals net operating income. So that cost of goods sold could have fixed and variable components. Selling and administrative expense also has fixed and variable components. The kind of income statement this is the kind that would be in a company's annual report. Financial statement readers would look at this and use ratio analysis and so forth. So this is not a contribution format, but that's okay because we have to do this kind for external reporting. Multiple predetermined overhead rates. You might have more than one. Let's say you have a machining division and an assembly division. The machining division, they have a few people and lots of machines. You may think that maybe machine hours would be the better predictor of your cost patterns. Whereas for assembly, you have a lot of people putting stuff together, assembling things. Not too many machines, maybe no machines. Labor hours might be better in that case. So for one department, you might have labor hours as the cost driver. Another department, you may have machine hours as the cost driver. So we call that multiple predetermined overhead rates.
Do they just share the rent cost then? Do they just take the rent cost by the department?
Yeah, what do you do with the rent? What you could do is divide it on the basis of square feet. Now let's say there's 10,000 square feet in the factory. The machining department has 3,000 of those square feet. 3,000 out of 10,000, 30% of the rent would be allocated to the machining department. The other 70% to some other departments. I have a war story to tell there. Yeah, it's even more exciting than the material, right? Yeah, once upon a time, I worked in the auditing department of a bank, and we allocated rent on the basis of square feet. Well, in the trust department is where all these high-priced attorneys hang out, and they manage assets. You know, somebody has a couple $1 million in the portfolio and stuff. They manage it, they buy the stocks and bonds and try and get a good rate of return, and they charge fees and stuff. And we allocated rent on the basis of square feet. They took up a lot of space because they had lots of offices. Their offices were bigger than the people who didn't have law degrees, and there were lots of them. Every time you turn around, you bump into an attorney. And so because we allocated on the basis of square feet, when it came time to look at the bottom line, their bottom line was in the red. It was a little negative. So they didn't make much profit to begin with. It was more of a service function. That, you know, if the president of some corporation wants to keep $100 million in the corporate checking account, we'll take care of his personal portfolio pretty much at cost almost. We won't make much profit off of that. But because of that, it was a low profit margin segment anyway. The lawyers have egos. Have you heard? Lawyers and doctors have egos. I've heard that. I don't know. But anyway, so they have egos. They didn't like the fact that their department was in the red. They were making less than nothing. They had negative earnings, is the term we tried to use. But anyway, they didn't like that. And it was because of the way we allocated the rent. So what we did was, for them, we made a little adjustment and we took out some of that deduction so that they would make a small profit and their egos would be soothed. So it's, any kind of allocation format is arbitrary. A nice way to allocate rent might be on the basis of square feet, or maybe not. It depends. The thing is, any allocation method is arbitrary. There'll be winners and losers. You can do it another way. Maybe you could do it on the basis of cubic feet. Cubic feet would have been worse because they had higher ceilings. I mean, if it's a plant facility, you may have really, really high ceilings. If you allocate it on the basis of cubic feet instead of square feet, more of that would be allocated to the factory. If you had a place that had 7-foot ceilings, they wouldn't get as much allocation if it were cubic feet. Sometimes cubic feet is appropriate. Let's say you have a storage facility for chemicals. You have all these vats, these really big vats. Or maybe chemicals isn't so sexy. Let's say it's 14-year sour mash whiskey. They have vats too, right? Yeah, and they're high. And maybe cubic feet, or cubic feet within the vats might be a more appropriate way to allocate. Thing is, any way you allocate, there are going to be winners and losers. And so what you try to do is not allocate a lot of that stuff, just deduct it from the bottom line, like we did in Chapter 3. Now, we didn't allocate a lot of those fixed costs then in Chapter 3. Now with the predetermined overhead rate, we allocate that stuff. But then you run into extra little human relations problems because people's little egos have to be soothed sometimes. So that's my war story for tonight. Attorneys and banks. Okay, so what didn't we cover on this slide? Oh, multiple predetermined overhead rates. Yeah. The nice thing about having just one overhead rate, they call it a plant-wide rate. Plant-wide rate. The good news about that, if there are positives and negatives, the positive thing about having just one rate is that it's easy to use. You just multiply by one number. The criticism that could be made of having a plant-wide rate is it's not as accurate. Again, if you have a lot of people working in the assembly department and a lot of machines in the machining department, if you have one plant-wide rate, one is going to be overestimated and one's going to be underestimated. You sort of split the difference. So if you have a plant-wide rate, it's not as accurate, not as precise, but it's easier. So there's positives and negatives to be said for that. Job order costing in service companies. You can use job order costing not only in manufacturing companies, but also in service companies. Although our attention is focused on manufacturing applications, it bears re-emphasizing that job order costing is also used in service companies. For example, in a law firm, each client represents a job. Legal forms and similar inputs represent direct materials. The time expended by attorneys represents direct labor. The cost of secretaries, clerks, rent, depreciation, and so forth represent the overhead. Do you remember reading about that tobacco settlement? That was like 10, 15, 20 years ago or something. They had these attorneys that came in, and there were, defense attorneys and prosecutors and all that. These defense attorneys, they had to fly around because the tobacco was in different places. And this one attorney, he was billing by the hour, and he also billed for the time he was on an airplane. And because of the time differences, he was actually able to bill for 25 hours in one day because he crossed time zones. That made the Wall Street Journal. I mean, it's a brilliant strategy, but he had to give a refund for that, some of that time. So he's billing the government, he's billing 25 hours in one day. So that's just, it's in the Wall Street Journal, so it must be true, right? Can't say that for the internet in general. Oh, it looks like that's the end of that. Okay, well, let's take a look at after the break. What break? Let's see. I have the screen here, and let's see. I get rid of this one, and then put this one up there. There we go. So we're starting with exercise 1 on page 142. Oops, too much. Some people are deciding to take their own break, I see. For those in cyberspace, my students are escaping for a break. Some of them, minority of 2 or 3. Maybe I didn't count them all. I don't know. Okay, I'm going to take a drink of my protein drink here while you're doing that. Okay. So we're on page 142. The nice thing about these exercises is that they're sort of separate and distinct, but yet they're related. A lot of times they'll ask almost the same question with a different fact situation, or they'll ask it in a little different way. Sort of makes you think, makes you ask yourself the question, what do they mean? But it's basically the same stuff over and over again. There may be 10 different points to make. By the time we get through all these, we're going to have enough repetition, hopefully, that you'll sort of see how things all fits together. Because it does all fit together. Accounting is like a puzzle with no pieces missing. Except maybe when you get into a PhD program, then they have a few pieces missing once in a while. Because it's not just accounting anymore. So again, page 142, exercise 1, compute the predetermined overhead rate. Well, we already know what that is, right? Logan Products computes its predetermined overhead rate annually on the basis of direct labor hours. At the beginning of the year, it estimated that 40,000 direct labor hours would be required for the period's estimated level of production. The company also estimated $466,000 of fixed manufacturing overhead expenses for the coming period and variable manufacturing overhead of $3 per direct labor hour. Logan's actual manufacturing overhead for the year was $713,400, and its actual total direct labor was 41,000 hours. So they thought it would be 40,000, but it was actually 41. That's 2.5% more than what they thought it would be. So the estimate's probably going to be off, even if their other estimates were right on target. So we have to compute the company's predetermined overhead rate. So here's how you do it. Again, the equation, y equals a plus bx. A represents the fixed cost, 466,000, plus $3 per direct labor hour is what their estimate was for labor hours, multiplied by the 40,000 labor hours they thought they were going to expend. They actually expended 41,000, but they didn't know that till the end of the year. So we have to use the 40,000. So the estimated fixed overhead that was given, 466,000, and then 40,000 direct labor hours at $3 each would be another 120. So they think that their overhead cost is going to be 586,000. That's the applied number. Again, applied means estimated. So the estimated total manufacturing overhead cost 586. So that 586,000 divided by the 40,000 direct labor hours they thought they would expend gives them a unit cost of $14.65. That's their predetermined overhead rate. Again, predetermined is the one they do at the beginning of the period. It's an estimate. So for every labor hour they expend, they multiply that by $14.65. So for any level of activity, you can estimate your total cost using that formula, y equals a plus bx, where y is the total cost, a is the estimated fixed cost, and the bx would be, in this case, whatever number they come up with times the number of labor hours. Then all that's combined pretty much in here, $14.65. If their fixed costs are different than what they estimated, that $14.65 is going to be off a little bit. If they actually worked 41,000 hours instead of 40,000, then the total cost, y, is going to be off a little bit. But then, when they know what the actual costs are, they can make adjustments. Any questions so far? We're just plugging stuff in, multiplying, dividing. That's it. Oh, I shouldn't. This isn't a slide, so I shouldn't just hit the down arrow. Did I miss anything? Okay, I didn't miss anything. Yeah, I have to not hit the down arrow because it's not a PowerPoint. Number 2. Oh, look at this one. There's only 3 lines. This has got to be easy. There's only a few things to deal with here. Apply overhead, number 2. Western Corporation uses a predetermined overhead rate of $23.10 per direct labor hour. This predetermined rate was based on a cost formula that estimated $277,200 of total manufacturing overhead for an estimated activity level of 12,000 direct labor hours. The company incurred actual total manufacturing overhead costs of $266,000 and 12,600 total direct labor hours during the period. So the requirement is to determine the amount of manufacturing overhead that would have been applied to all jobs during the period. So the actual direct labor hours, 12,006 multiplied by the predetermined overhead rate, 2310. So the number we come up with is the product of those, 291,060. So again, half the battle is just understanding what they're looking for. They only give us a few numbers to work with. We just have to figure out what do we do with them. So that would be a good exam question, I guess. Number 3, computing job costs. Another 10-minute thing, but this takes a few more lines. Weaver Company's predetermined overhead rate is $18 per direct labor hour, and its direct labor wage rate is $12 per hour. The following information pertains to job A200. So you have direct materials, 200, direct labor, 120, and the other manufacturing cost overhead, we have to figure that out. What is the total manufacturing cost assigned to job A200? Well, that would be direct material plus direct labor plus manufacturing overhead. So what do we have? We have the direct labor cost, 120, and the hourly rate is 12. So how many labor hours did it take? 10, right? $120 divided by $12, 10 direct labor hours. The total manufacturing cost assigned would be those 3 manufacturing costs: direct material, direct labor, and overhead. Direct materials, that was given at 200. Direct labor was given at 120. Now all we have to do is figure out what's the indirect cost, manufacturing overhead. Well, we know that we're using 10 direct labor hours at 18 per hour. So 18 times 10, 180. We add that up. That's 500. So that's for part A. For part B, if job A200 consisted of 50 units, what is the average cost assigned to each unit included in the job? So we take 500 divided by 50, and we get 10. That's the unit product cost. What if you usually sell these things for $25 a unit, and some outsider from Nebraska said, we'd like to buy 5,000 units at 15 per unit? Would you say yes or no? Yes. It only costs you 10. You can sell it for 15, and the people here in North Carolina won't know that you're selling it for 15 instead of 25, because those people are in Nebraska. And nobody from here is going to tell your existing client base, right? Or else they would demand 15 as well. So the minimum price you can charge without losing money is 10. So if somebody, an outsider not in your current market, comes to you and wants to pay more than 10, you should say yes, assuming you have enough excess capacity to handle the business. If you don't, then you're going to have to decide, who not to sell to. But again, this is an application that you can use. The minimum price you can charge for this without losing money is 10. Number 4, this has 4 parts. Well, it says it has 4 parts.
Only had 2.
Hmm?
They only had 2.
2?
Only had 2.
2 parts?
Yeah.
Oh, this is A, B, C, D. Oh,
That's for
determine underapplied and overhead. Oh, so you only have to answer one question. They have 4 bits of information, I guess. Whoops, I stand corrected. So exercise 4, determine underapplied or overapplied overhead. Again, underapplied means underestimated. Overapplied means overestimated. Croquet Company recorded the following transactions for the just completed month. Now, when you have something like this and they give you a lot of information, don't just read through it. Go to the requirement first so you can see what's important. So let's look at the requirement. Determine the underapplied or overapplied overhead for the month. So now you know what you're looking for. You'll know which of this information is important. Maybe we're not going to use all of this information, or maybe we are. This is like a CPA exam test-taking technique because you're up against time. So you have to make most efficient allocation of your time, figure out what they're looking for first. That way, when you go through the fact situation, you'll know what's important and what isn't. So they recorded the following transactions for the just completed month, Part A. $84,000 in raw materials were requisitioned for use in production. Of this amount, $72,000 was for direct materials, and the remainder was for indirect materials. So how much of that $72,000 is going to be part of cost of goods sold eventually? Or I could ask it another way. How much of this is a manufacturing cost?
72,000.
Well, the 72,000 is direct materials. That's a manufacturing cost. What about indirect materials? Is that a manufacturing cost? Yes, that's part of overhead. Right? Any manufacturing cost that's indirect is overhead. So 72,000 is direct, the other 12,000 is indirect, but they're both manufacturing costs because it's raw material. Raw material is one of the manufacturing items. Part B, yes?
Question. Yeah, that's tricky.
Well,
Can you say indirect is like miscellaneous, they're not really naming every nut, bolt, or whatever, but it's still, they still need these items to make this product.
Right.
You know how you use word association?
Yeah.
Because yeah, indirect and direct, mean like there's a big split, but they work together, right?
Yeah.
Okay.
Because right now you're trying to figure out manufacturing overhead,
Right, yeah. Yeah, there's three components to manufacturing cost: direct material, direct labor, and any other manufacturing cost. Any other manufacturing cost would be overhead. So when they say direct materials, indirect materials is overhead. Indirect labor is overhead. The janitor's salary for sweeping up the factory, that's overhead. That's an indirect labor cost. Janitor's salary, indirect labor cost, overhead. Yeah, so the reason I raised the question is just to sort of so you would understand that any manufacturing cost becomes part of cost of goods sold at some point when you sell the product. So indirect materials is overhead. Indirect labor is overhead. Miscellaneous other manufacturing cost is overhead because it's a manufacturing cost. So that 84,000, all of that's a manufacturing cost. 72,000 is direct and the other 12,000 is indirect, but it's all a manufacturing cost. Part B, total labor hours of 108,000 were incurred. Of this amount, 105,000 was for direct labor, and the remainder was indirect labor. So that's 3,000, right? 3,000 is indirect labor. Is indirect labor a manufacturing cost?
Yes.
Yes. Yes. Well, in this case, because it's a manufacturing operation. So 3,000 is overhead. The other 105 is direct labor. Part C, additional actual manufacturing overhead costs of 197,000 were incurred. And Part D, a total of 218,000 in manufacturing overhead was applied to the jobs. So the estimate was 218,000. It was applied an estimated amount. So the requirement determined the underapplied or overapplied overhead. So we have to figure out how much did we estimate that it would be. So indirect materials, 84 minus 72 is 12. Indirect labor, 108 minus 105 is 3. And the additional actual manufacturing overhead costs were 197. So the actual costs were 212,000. They applied 218,000. That's 6,000 more. So they overestimated. They estimated 218. It was only 212. So it's overapplied, overestimated. I thought there was a question there. It's just,
What's the synonym you said you used for applied again?
estimated. Yeah, overestimated. This is overapplied, overestimated. It's too much. Cost of goods sold is going to be 6,000 too much. So the cost of goods sold that goes on the income statement, on the annual report, the financial statements, is going to have to be 6,000 less than what we have now. Now it's 218,000. It should be 212. So we take 6,000 out of cost of goods sold. What effect does that have on gross profit? Does it increase or decrease gross profit? It increases, yeah, because we're subtracting 6,000 less. Gross profit increases by 6,000. We have to take 6,000 out of our cost of goods sold because we have 218,000 in there now. It should only be 212,000. We report the actual numbers when we know what they are. And at the end of the period, we know what they are. And it's subject to maybe some minor adjustments later. But that's in the financial accounting class, right? We don't have to deal with that. So that's it for number 4. Number 5, direct method of determining cost of goods sold. Remember, nobody liked the direct method. Everybody, one person liked the indirect. Nobody liked the direct method. One person liked the indirect. And I guess the rest of you were indifferent as to which one, because you like them both equally, I guess. Because nobody raised their hand for that one. So let's take a look. Direct method, this is number 5. Direct method of determining cost of goods sold. There's a lot of information there. Let's skip to the requirements. There's 3 of them. First one, using the direct method, what is the cost of goods sold? Number 2, what is the total value of the finished goods inventory at the end of May? Number 3, what is the total value of the work in process inventory at the end of May? So now there are 3 things we have to look for. Now we can go back and read through the fact situation to determine what's important. Morrow Corporation had only 1 job in process during May, job X32Z, and had no finished goods inventory on May 1st. Job X32Z was started in April and finished during May, which means they're going to have some work in process inventory at the end of April because it's not finished. Data concerning that job appear below. The beginning balance was $5,000. Charged to the job during May, you had direct materials, direct labor, manufacturing overhead applied, meaning estimated. And then they completed 100 units. Units in process at the end of May were 0, and the units sold during May were 40. In May, overhead was over-applied or overestimated by 300. The company adjusts its cost of goods sold every month for the amount of the overhead that was under-applied or over-applied. So that 300 is going to be just the cost of goods sold. It's not going to be allocated among those other 3 T accounts because that's what the authors said they're going to do. So the first requirement, using the direct method, what is cost of goods sold for May? So we have the beginning balance, 5,000, plus direct materials, 8,000, and direct labor, 2,000, manufacturing overhead applied 4. So the total there is 19,000. They completed 100 units, so $19,000 divided by 100 units. The unit product cost is 190. They sold 40 units, so 190 times 40 is 7,600. That's the cost of goods sold. They call it unadjusted cost of goods sold. Why do they call it unadjusted cost of goods sold?
Because you haven't adjusted for the overrun.
Yeah, we haven't adjusted for that 300 too much that they put in before, right? It really should be 7,300, but it's 76. How do we know that? Because it said it was over-applied by 300. So the cost of goods sold must be adjusted for the over-applied, meaning overestimated overhead as follows. The unadjusted, which we just figured out, 7,600, and then we subtract that 300 because that's an overestimate. The actual cost is only 7,300. It's currently on the books at 7,600. We have to get rid of that 300 to bring it down to the 7,300. So the actual cost, the one that goes on the annual report, 7,300. So that's it for part 1. The second part, what is the total value of the finished goods inventory? If they had 100 units and they sold 40, it means they didn't sell 60. So units completed 100, they sold 40, you have 60 left. 60 they didn't sell. Those go in the ending inventory. And what cost? What cost should we assign to those? 190. 60 times 190, the ending inventory, finished goods inventory, is 11,400. And the third one, what is the total value of work in process inventory at the end of May? There isn't any, so the value is 0. They had work in process at the beginning, but we added that already, right, in that first part. So that's it. Number 6, using the indirect method. Refer to the same fact situation as in number 5, except now we're going to use the indirect method. Should we get the same answer? Does it matter whether we use the direct or indirect method? Shouldn't make a difference. We should get the same answer. So for number 6, again, to determine the cost of goods sold using the indirect method, we need the beginning work in process inventory, which they gave us. Total manufacturing cost charged to jobs, they gave us that. The ending work in process inventory was 0. The beginning finished goods inventory and the ending finished goods inventory. These values can be determined as follows. The beginning work in process inventory was 5,000. That was given. Total manufacturing costs, direct materials was given, direct labor was given, manufacturing overhead applied or estimated was 4,000. So the total manufacturing cost was charged to the jobs, 14,000. No ending work in process inventory, so that's 0. No beginning finished goods inventory, so that's 0. So the value of the ending finished goods inventory, you have the beginning balance, 5,000 plus direct material, direct labor, overhead applied, gives us a total of $190,000. We had 100 units, so $19,000 divided by 100 units is $190 per unit. They completed 100 units. They only sold 40, which means they did not sell 60. 60 times 190 is 11,004. Then cost of goods sold. We had, let's scroll up here.
You can see up there too, 8,000.
Hmm? Yeah, it's 8,000 up there too. Yeah, a lot of this is just repeated. Yeah, direct material, 8, direct labor, then manufacturing overhead applied, and then the beginning work in process. You had a total of 19, 14,000. It was charged to jobs plus the 5,000 you had at the beginning, gives you 19,000 you had at the end. There was nothing in process at the end because everything was finished, so 19,000 would be the cost of goods manufactured. Let me see if you got the answer to this. What's the difference between the cost of goods manufactured and the cost of goods sold? Ending finished goods inventory, right? Yeah, you take cost of goods manufactured plus the beginning balance for finished goods inventory minus the ending balance for finished goods inventory. That gives you cost of goods sold. So the only difference between cost of goods manufactured and cost of goods sold is the change in the balance of the finished goods inventory. Add the beginning, subtract the end of the finished goods inventory. That gives you cost of goods sold. So beginning finished goods inventory, they didn't have any. You add the cost of goods sold, and we just computed 19,000. So goods available for sale, if you sold everything you had, the cost of that would be 19,000. But you didn't sell everything. You only sold 40 units. You didn't sell 60. So you subtract what you didn't sell, the ending inventory, and that gives you what you did sell. Well, not exactly. That's the unadjusted balance, but it was over applied from the prior period, so you have to extract that 300 deducted that you shouldn't have. And so the actual cost of goods sold is going to be $300 less. This is over applied, overestimated by 300. 7,600 should be 7,300. So you get the same answer. It's just this is the indirect method. 2 different ways to arrive at the same answer. This gives more detail. It's a fuller explanation, or exposition if you prefer, with the same answer. Number 7, predetermined overhead rates, applying overhead underapplied or overapplied. Again, same thing, just different fact situation. Medusa Products uses a job order costing system. Overhead costs are applied to jobs on the basis of machine hours. At the beginning of the year, management estimated that the company would work 85,000 machine hours and incur 170,000 in manufacturing overhead costs for the year. They only give you 2 numbers. What do you want to do with those 2 numbers? Divide. 170 by 85 gives you 2. You can do that in your head, right? Just chop off 4 zeros. Or 3 zeros. As long as you move the decimal place to the left the same number of places, it doesn't matter. First requirement, compute the company's predetermined overhead rate. Well, we know that's 2 because it's $170,000 divided by units. Dollars divided by units will give you dollars. So $2 per machine hour. Number 2, assume that during the year the company actually worked only 80,000 machine hours and incurred 168,000 in manufacturing overhead costs. Compute the amount of underapplied or overapplied overhead. Well, what do you want to do with the $2? Multiply it by 80,000. You get 160,000. But the actual overhead was 168, so you were off by 8. Did you overestimate or underestimate? Well, the actual was 168, you estimated 160, so it'd be under, right? Well, that would have been your second choice, right? Yeah. So now it's tricky. I mean, there's only 2 options here. It's either over or under, but getting the right one is sometimes a little tricky, right? Yeah. Yeah. So if you forget about the terminology underapplied, underapplied means underestimated.
Yeah.
Yeah. So applied, estimated, you thought it was going to be 160, but it was actually 168. So you underestimated. So that means you have to take the excess here, that 8,000, and take an extra deduction. You only deducted 160. You should have deducted 168. So you have to subtract 6 more, or 8 more, 8 more. That reduces, or that increases cost of goods sold. It reduces the next line on the income statement, which is in sales minus cost of goods sold equals gross profit or gross margin, right? So that would reduce gross margin by 8,000. And for part 3, explain why the manufacturing overhead was underapplied or overapplied. Well, what can we say about that? I mean, it's just the overhead rate wasn't 2. It should have been more than 2. And that's sort of what they say in that material. It's 12, 13 lines, whatever that is. It wasn't 2, it was higher than 2. That's basically why it was off. And again, you can read that. We don't need to read that, do we?
Can you also say just underestimated?
Yeah, underestimated. Yeah. Yeah, we underestimated. Something happened. One of our suppliers increased prices more than we thought. Maybe the union got a 5% raise instead of 3%. Maybe we had to get an alternative supplier that charged a little more. Maybe there was a hurricane in Houston, gasoline prices went up. That would never happen, would it? Oh, did you notice gasoline prices? They used to be like $1.99. Now they're $2.45. It's only a couple of days later. And another one headed for the coast, perhaps. They just don't know which coast yet. Well, East Coast, but is it going to hit Louisiana or Florida, North Carolina? Get on a plane, go to Paris. But again, Paris isn't what it used to be. Number 8. Computing predetermined overhead rates and job costs. Same question again. Overhead rates. Cody Corporation uses the job order costing system with a plant-wide overhead rate based on machine hours. At the beginning of the year, the company made the following estimates. Machine hours required to support estimated production, 150,000. Fixed manufacturing overhead costs, 750. Variable manufacturing overhead costs, $4. Doesn't this just scream out for an equation? Yeah, y equals a plus bx. Yeah, plug it in pretty much. So the first requirement, compute the predetermined overhead rate. So there it is. Fixed cost is 750. Y equals a plus bx. A is 750,000. B is $4 a unit, and X is 150,000. So 750,000 is the estimated fixed overhead, and the estimated variable, $4 times 150,000, 600,000. So the total, 1,350,000. That's what you think the overhead cost is going to be. So the predetermined overhead rate is the 1,350,000 divided by the number of machine hours you think you're going to expend, and that gives you $9. So for every dollar the machine runs, you add $9 to overhead. That's how you'd use that. Every hour the machine runs, add $9 to the overhead. That's it for part 1. Part 2, during the year, job 500 was started and completed. The following information was available with respect to this job. Compute the total manufacturing cost assigned to job 500. So direct materials requisition, 350, direct labor cost, 230. Whenever you see the number 230, what do you think of? So some of these numbers have an independent significance, right? 230. It's time to go to the dentist. Tooth hurting? It's my mother's joke. You have to laugh. Tooth hurting. Okay. It's the best I can do. I'm stealing jokes from my mother now. So, okay. So anyway, direct labor cost. You may remember nothing of the course 5 years from now, but you remember that sick joke, right? Okay. As long as you remember something. So, okay. So machine hours used, 30. So you're probably going to multiply that 30 by something. So, 9. Yeah, let's multiply it by 9. 30 times 9 is 270. So yeah, direct material, direct labor, and overhead. Those are the three manufacturing costs. Direct material, direct labor, those were given. And this one we had to figure out, 9 times 30. So 850, that's the total manufacturing cost. And part 3, during the year, the company worked a total of 147,000 machine hours on all jobs and incurred actual manufacturing overhead costs of $1,325,000. So what do you want to do now? Slow down, scroll down, scroll down. Yeah. Well, you're going to take that 1,325,000 and compare it to what you thought it was going to be. And the difference is going to be underapplied or overapplied. So they worked a total of 147,000 machine hours on all jobs and incurred actual manufacturing overhead cost of $1,325,000. What is the amount of underapplied or overapplied overhead for the year? So first of all, we calculate the number, then we have to ask, is it overapplied or underapplied? So it's a two-part question. If this amount were closed out entirely to cost of goods sold, would net operating income increase or decrease? So what do we have? The actual cost, overhead costs, $1,325,000, that was given. The actual machine hours, 147,000 times $9, the predetermined overhead rate. So we think that the cost is going to be $1,323,000, but it's actually $1,325,000, a difference of $2,000 that would be underapplied because we estimated it would be $1,323,000, and the actual was more than that. So we underestimated this would be underapplied. That means we have to deduct $2,000 more. What happens when we take an extra $2,000 in cost of goods sold? Sales minus cost of goods sold equals gross profit. If we take an extra 2 in deductions, the next line, gross profit's going to be 2,000 less, right? Yeah, we're taking an extra 2,000 in deductions. So cost of goods sold is 2,000 more than what we thought, 1,325,000 instead of 1,323,000. Take an extra 2,000 deductions, so gross profit, gross margin is going to be 2,000 less because we're taking an extra 2,000 in deductions. And that's basically what it says, net operating income. But I might ask, what's the difference between net operating income and gross profit? Gross profit, net operating income. What's the difference between the two? You deduct extra stuff, right? You start with sales minus cost of goods sold equals gross profit, and then you subtract things like selling and administrative costs, then you have net operating income. So gross profit is going to be 2,000 less, and net operating income is also going to be 2,000 less because you don't take the tax into consideration until farther down on the income statement. So there's two ways they could ask the question. They can say, what's going to be the effect on net operating income? Or they can say, what's going to be the effect on gross profit? The answer is going to be the same, 2,000 less. And number 9, departmental overhead rates. Ooh. Let's look at the requirements. There are 3 of them. The bottom of page 144. When you see the number 144, what do you think of? Is that a gross number? Isn't 12 times 12 a gross number? Taking you back to third grade math here, folks. 12 times 12 is 144. It's 12 gross. Gross, right? Yes, no. It's not on the CPA exam. I just couldn't help myself. Page 144. So the first requirement for number 9, compute the predetermined overhead rate to be used. Second requirement, assume that the overhead rates you computed in requirement 1 are in effect. The job cost sheet for job 407, which is started and completed during the year, blah, blah, blah. Compute the total manufacturing cost assigned. So that's the second one. Third one, would you expect substantially different amounts of overhead costs to be charged to some jobs if the company used a plant-wide overhead rate based on direct labor hours instead of using departmental rates? You don't have to make any computations here. Remember before we were saying, what's the advantage of having just one plant-wide overhead rate? What's the advantage of that? It's easy, simpler, because you only have one number to multiply by. What's the disadvantage of having just one? It's not as accurate. Yeah. If one department used a lot of machinery, you'd want to use the machine hours to figure out the overhead rate. If you have an assembly department that uses a lot of labor, direct labor hours would be a different indicator because they're cost of drivers. Remember that? Cost drivers. And so let's take a look at the fact situation. The oil company has 2 departments, milling and assembly. The company uses a job order costing system and computes a predetermined overhead rate in each department. The milling department bases its rate on machine hours because the milling department uses machines. The assembly department bases its rate on direct labor hours because assembly, you have people that assemble stuff. At the beginning of the year, the company made the following estimates for the 2 departments, milling and assembly. Direct labor hours, it's only 8,000 in milling because that's mostly machines. In assembly, it's 80,000 because that's mostly people. Machine hours in milling is 60,000. That's a lot because milling uses machines. In assembly, they only use 3,000 hours for machines. So the total fixed manufacturing overhead cost, 390 for milling, 500,000 for assembly. The variable manufacturing overhead per machine hour is $2. That would only be under milling though, because you're using machine hours for milling, you're using direct labor hours for assembly. And the variable manufacturing overhead direct labor hours, 375 for assembly. So the first requirement, compute the predetermined overhead rate for each department. So for one, you would use the number for milling, that would be machine hours. For assembly would be direct labor hours. So again, y equals a plus bx. For milling department, fixed cost is $390 plus $2 per machine hour multiplied by 60,000 machine hours. So the estimated fixed manufacturing overhead $390 plus $2 times 60 is $120. Total then for milling $510,000. That's what their estimate is for overhead. And the predetermined overhead rate is $510 divided by the 60,000 machine hours, or $8.50 per machine hour. So that's the predetermined overhead rate you'd use for milling. It's based on machine hours. For assembly, it's going to be based on direct labor hours. Let me scroll up for that one. The same exact process, except now you're not using machine hours because it's the assembly department. For assembly, you use direct labor hours because that's a better fit. It's the cost driver. Milling would be machine hours, assembly would be direct labor hours. So y equals a plus bx. 500,000 is fixed cost. The overhead rate, $3.75, and for direct labor hours, times 80,000. So 500,000 is their estimated fixed manufacturing overhead. 300,000 is the estimated variable manufacturing overhead. Again, the overhead rate, $3.75, based on direct labor hours, DLH, direct labor hours, times 80,000 direct labor hours, 300,000. The total then, 800,000. And if the total is 800,000, and that's for 80,000 direct labor hours, $800,000 divided by 80,000 units gives you $10 for direct labor hour. So every hour somebody works in assembly, you add $10 to overhead in the assembly department. That's what that means. Now that we have those numbers, for part 2, assume that the overhead rates you computed in requirement 1 are in effect. The job cost sheet for job 407, which was started and completed during the year, show the following. What if it was started but not completed? How would that complicate things? Here it's started and completed. But what if it were started but not completed? There'd be a work in process inventory, and we'd have to figure that out, right? Yeah. But they don't have that. They're started and completed. So they have direct labor hours, innocently. So here you just have to figure out, we multiply something by 5 and we multiply something else by 20. And then they have machine hours 90 and 4, materials requisition. So for materials, that's direct material cost and the direct labor cost they give us. So we have direct material, direct labor, and overhead. The only real sticking point is the overhead, because for assembly, we multiply that by direct labor hours. For milling, we multiply it by machine hours. So compute the total manufacturing cost that's assigned to that job. So we have direct materials, 800 plus 370 for the 2 departments. And direct labor, 45 plus 160. Those are both given. And then here, this is really the only complicated part. In the case of milling, we use machine hours. That was 90, which we determined, times 850. Okay, we determined that. And then the assembly department, we determined that, $10 times 20, because they use 20 direct labor hours. And some of those too, then 965. So we have the 3 manufacturing costs, direct material, direct labor, and overhead. And that's what we get, 2,340. That's the total manufacturing cost.
Where did you get the direct labor, 45 and 60? Oh, never mind.
Yeah, that was scaled.
So the direct labor hours, the 5 and 20,
Yeah, those are
was
good.
it was just like a decoy?
Yeah,
It wasn't relevant?
yeah, it wasn't relevant. In milling, we don't use direct labor hours, and in assembly, we don't use machine hours. Yeah, so it's good that you pointed that out. Some of these numbers at the bottom of page 144, the second requirement, we don't use some of these, right? Direct labor hours for milling, we don't use that 5, because in milling, we don't use direct labor hours, we use machine hours. And machine hours in assembly, 4, we don't use that, because in assembly, we use direct labor hours, not machine hours. And so the 5 and the 4 we don't use. Just extra information. So they do that on the CPA exam too sometimes. They throw information in there you don't use, and you spend time worrying because you don't know how to use it. Yeah, just adds to the tension. Number 3, would you expect substantially different amounts of overhead costs to be charged to some jobs if the company used a plant-wide overhead rate based on direct labor hours instead of using departmental rates? Sure. Here we have 2 different cost drivers. In the milling department, it's machine hours. In assembly, it's labor hours. What if they use just labor hours or just machine hours? Then it would be off, right? And depending on whether that particular product used a lot of machines or a lot of people, it could be either too high or too low. It just depends.
What if you could have just one predetermined cost?
Yeah, if you had one predetermined overhead rate, half your jobs would be overestimated and half would be under, maybe. The reason I say maybe is because it's not clear cut. It depends on the facts and stuff. So the nice thing about having just one predetermined overhead rate instead of 2, one for machine hours and one for labor hours, the advantage of having just one is it's easier. You only have 1 instead of 2, and you don't have to decide what do I multiply because there's only one number. The problem with just having one plant-wide predetermined overhead rate is that you can't split it into machine hours and labor hours. Those are both cost drivers, but they have a different effect on costs. So we don't have to come up with numbers. It says no computations are necessary because it's a theoretical question. So again, there's an advantage and a disadvantage to having just one plant-wide predetermined overhead rate. Again, the advantage is it's easy. The disadvantage is it's not as accurate. Number 10. Applying overhead again, compute unit product cost. The company assigns overhead costs to completed jobs on the basis of 120% of direct labor costs. So whatever labor costs are, you multiply that by 120%, and that's your estimated overhead. The job cost sheet for job 413 shows that $12,000 in direct materials has been used on the job, and that $8,000 in direct labor costs has been incurred. So they give us two of the three components, direct material and direct labor. We only have to figure out overhead. A total of 200 units were produced in job 413. So the requirement, what is the total manufacturing cost assigned to job 413? We have the three components. Direct material they gave us, direct labor they gave us. All we have to figure is the indirect stuff, manufacturing overhead, add that to the other two, and we have our answer. Then what is the unit product cost? We have to divide that by the number of units. They tell us 200 units, so whatever we got before, we divide by 200. So what do we have? We have direct material, 12,000, direct labor, 8,000, the manufacturing overhead, 8,000 times 120%. That's the overhead that's assigned. May not be the correct one. It's applied. It's estimated. So we get 29,600, and that's for 200 units. So the unit cost that we would assign is 29,600 divided by 200, or $148. So if somebody comes to you and said, we'd like to buy 100 of these units for 150, would you sell it?
Yes.
Yeah, because it's more than 148. What's the lowest cost you could charge without losing money? 148. Yeah. Yeah, if you want to make money, you charge 148.01.
Would you like look at your materials available, like perhaps doing that job at such a low profit would take away from the materials and you might not be able to replenish as quickly?
Yeah, that's true. There are other things to consider. You know, all other things being equal, you would sell as many units as you could produce for anything more than 148. But if you had alternative uses, let's say you can only make 10,000 units a month, and you have people who want to buy 12,000, then you'd have to determine which 2,000 units aren't going to be sold to somebody. You know, if you can only produce 10,000 units a month and you have demand for 12,000, then somebody's not going to get it. Somebody's not going to get it. So whoever pays the highest price gets it. So, but that's what they call a bottleneck or a constraint. And then there are other things you could do. If your workers are only working 40 hours a week, you can figure out if I paid them time and a half for overtime, would that be a good investment? Or maybe I should hire some part-timers at whatever, and you wouldn't have to pay time and a half, but maybe they wouldn't be as efficient because they're new and they're part-timers and they're on that low part of the learning curve. Or maybe you can outsource some of it, and that has a cost. So you might have like three options. Either keep the workers you have, pay them overtime, or just have your regular workers work 40 hours a week, hire some part-timers, or outsource some of it. So at least three choices there. And it's assuming you have capacity constraints, which we're going to get to in a few chapters.
No thanks.
No thanks. I'm just trying to whet your appetite because there's so much good stuff that lies ahead. Just not right away. Number 11, underapplied and overapplied overhead. How many ways can they ask the same question, right? They give us the fact situation, then we're supposed to determine, is it overapplied or underapplied by how much? Cretan Enterprises uses a predetermined overhead rate of $21.40 per direct labor hour. This predetermined rate was based on a cost formula that estimated $171,200 of total manufacturing overhead for an estimated activity level of 8,000 direct labor hours. The company incurred actual total manufacturing overhead costs of $172,500 and 8,250 total direct labor hours during the period. So they give us 1, 2, 3, 4, 5 numbers there. What do we do with those 5? Add some of them and maybe subtract others. You know, the estimated activity was 8,000 direct labor hours, and they actually used 8,250. They used more than what they thought. So do you think their total cost is going to be over-applied or under-applied, even without doing any math? Yeah, if the actual is going to be 8,250, that's going to be a larger number than what they estimated at 8,000. So something's going to be over-applied because the level of activity, the volume is going to be higher, unless the numbers are way out of whack. That could be too. But all other things being equal, it looks like something's going to be over-applied because they worked an extra 250 hours, 8,250 instead of 8,000. So it's probably going to be over-applied, but let's see. The first requirement, determine the amount of under-applied or over-applied manufacturing overhead for the period. So what do we have? The actual direct labor hours, 8,250. The predetermined overhead rate, $21.40. So that's 176,550. That's the amount estimated or applied, and then the actual amount, 172.5, or less manufacturing overhead incurred, rather, I should say. But that's the actual amount. 4,050 is the number. Then we just have to ask ourselves the question: is that over-applied or under-applied? Well, it's over-applied in this case, because the estimated is more than the actual. The estimated 176,550, and the actual is less than that. We could guess that it was going to be over-applied because they work more hours, 8,250 instead of 8,000. So we could guess it would be over-applied. It's just a question of how much. And for part 2, assuming that the entire amount of the under-applied or over-applied overhead is closed out to cost of goods sold, what would be the effect of the under-applied or over-applied overhead on the company's gross margin? Or we could say net operating income. That's a different number, but the effect would be the same. It would either reduce it or increase it. Well, what would it do? Because it's over-applied, meaning overestimated, it means they deducted too much. If they deducted too much, you have to take some of that out of cost of goods sold, so you're subtracting less, which means the next line, gross margin, and also net operating income, would increase. If you reduce the cost, there's more left, right? Sales minus cost of goods sold equals gross profit. If cost of goods sold shrinks, the next line down, gross profit's going to expand, and so will net operating income. That will also expand by the same amount, 4,050 in this case. Are you starting to see a pattern? I hope so.
Every time it's going to the cost of goods increase. It's associated with
Yeah. Yeah, there's a relationship, you know, cost of goods sold, gross profit. If one goes up, the other goes down, and so forth. They keep asking the same questions, you know, what's the amount and what effect does it have on either net operating income or gross profit? The different fact situation, you have to put it together in different ways, but same thing over and over again. Okay, when you see the number 412, what do you think of? April 12th, right? April 12th. What happened on April 12th? 1861. April 12th, 1861.
shot.
Yeah, Civil War started in Sumter, South Carolina. What happened April 12th, 1945?
You were born.
No. That's FDR died April 12th, 1945. Yeah. And April 12th is also Yuri Gagarin's birthday. Who is Yuri Gagarin? Yuri Gagarin?
Gregorian calendar?
It's a good guess. No. It's a good guess. So Gagarin calendar? No. No, Yuri Gagarin was the first Soviet cosmonaut. His birthday is April 12th. I don't know what Yuri. April 12th. Yuri Gagarin, it was his birthday. The first Soviet cosmonaut. Cosmonaut. He circled the Earth once or twice before our guys did. Yeah. I think that was 1957. He wasn't born then, but that's when he circled it. So. Okay, so enough of that trivia. So what are they asking for? Number 12, applying overhead costs to goods manufactured. Cost of goods manufactured. Okay, what's the difference between cost of goods manufactured and cost of goods sold? Finished goods inventory, right? Yeah. The only difference between cost of goods manufactured and cost of goods sold is the change in the balance of the finished goods inventory. That's the only difference. So the following cost data relate to the manufacturing activities of Black Company during the just completed year. So they have all this stuff, all these manufacturing overhead costs incurred. And then other costs, purchases of raw materials, direct labor costs, and then the various inventories. So now we're getting into the T accounts. I wish I had board space to put all this stuff in. You have a beginning and ending balance for each class of inventory. Raw materials, T account, beginning and ending balance. You increase raw materials with purchases. So you debit purchases and credit either cash or accounts payable. The next T account, work in process. You have a beginning balance of 6,000 and ending balance of 7,500. You can do these using T accounts. For work in process, you also have some debits. One debit would be when you transfer stuff out of raw materials, you put it into work in process. So the credit would be raw materials inventory, the debit would be work in process. Then you have direct materials, direct labor, and overhead. You'd have those three debits in the work in process inventory. When you credit work in process inventory, what do you debit? What's the next T account? There's 4 T accounts here, right? Raw materials inventory, work in process inventory, finished goods inventory, cost of goods sold. Those are the 4 T accounts. So when you credit work in process inventory, the debit goes into the next T account, finished goods inventory. When do you credit finished goods inventory? The offsetting debit is cost of goods sold. Yeah. Okay. So that's the relationship. So what do we have? The company uses a predetermined overhead rate to apply overhead costs to jobs. The rate for the year was $5 per machine hour. A total of 10,000 machine hours was recorded for the year. All raw materials ultimately become direct materials. None are classified as indirect materials. Well, that's nice to know, but does it really make a difference when you're figuring cost of goods sold? Either way, it's a manufacturing cost. Either way, it's going to be a product cost. So it's nice to know that none of those are direct materials, but it's not going to affect the bottom line at all because it's going to go to the same place, cost of goods sold. First requirement, compute the amount of underapplied or overapplied overhead costs for the year. And the second part, prepare a schedule of cost of goods manufactured for the year using the indirect method. So let's take a look. This is a little complicated maybe. For part 1, again, the actual manufacturing overhead cost, that was given 48,000. Manufacturing overhead applied, 10,000 machine hours times $5 per machine hour. So the overhead cost, the overapplied overhead cost is 2,000. And for direct materials, here's where it gets a little complicated. It's maybe easier to understand if you use T accounts, but if your boss asked you to do this, you wouldn't show T accounts to the boss, right? You use a nice accounting format like this, so you can show the boss you know what you're doing. But on a CPA exam, you use T accounts because it's easier and faster to picture the flow of things. So you have the beginning balance of raw materials, then that increases whenever you purchase raw materials, so you add 32,000 to that, and then you subtract whatever the ending balance is. The difference between the 40,000 and the ending balance must have been the amount you transferred to the next stage of production. When it's no longer raw materials, the next stage of production is work in progress or work in process, depending on the textbook. And so that 33,000 would be transferred there. Raw materials used in production, that goes into work in process. Then you have the direct labor cost, that goes to work in process. And then the manufacturing overhead cost that's applied to the work in process, that's another debit on that T account under work in process. Total of 123,000. So you have, then you add the beginning balance to work in process. So you have those 3 debits, plus the beginning balance is a debit as well. You add that, 129,000, and then you subtract whatever's in there at the end. The difference between all these debits and the ending balance would be the amount you transfer to the next stage of production. When it's no longer in process, it goes into finished goods. That's the next stage of production. So 121,500, that would be cost of goods manufactured. If you wanted cost of goods sold, what would you do? Start with 121.5, and what adjustment would you make? Cost of goods manufactured to cost of goods sold. You add the beginning finished goods balance, subtract the ending finished goods balance, then you have cost of goods sold. Yeah, that's the only difference between the two. Do they ask you to do that here? Compute the amount of unapplied overhead, prepare schedule cost of goods for manufacturing. They don't ask you to do that. It's a shame. Well, you know what to do, right? You take the 121.5 and you add the beginning balance. Well, that's all there is to that. Okay. Oh, people are packing up. It's the time to leave. Is you had enough? Are you screaming now? You've had enough? No, it's 8:30. Yeah. If we take a 20-minute break, it'll be 8:50. We're supposed to end at 8:50, but that's with a break. So let's take our 20-minute break and then we'll leave. Or whatever. Okay. If anyone out there in cyberspace has a question, I'll hang around for a few minutes. Yeah, thanks for staying. I'm not saying it's rude to leave early. I'm just saying thank you for staying. I can take it.
My mind on this, and my 15-year-old is texting me about homework.
Oh, yeah, good luck with that.
They declared state of emergency.
Is there a state of emergency?
Yeah, starting tomorrow.
At 8 o'clock.
Uh-oh, I'm supposed to be somewhere tomorrow. Oh, well, Pembroke. Yeah, there's a conference, an academic conference I'm supposed to go to tomorrow.
They activated Florida, Georgia, South Carolina, National Guard, I think one other state. So they're anticipating a pathway like through Miami towards Tallahassee.
Oh, okay.
We'll see what happens.
Yeah.
Whoa.
Okay, well, thanks for coming. If you have questions, send me an email. You can send it at 2 a.m. if you want. I may not answer it at 2 a.m.
It's all right. Today was solid. Thanks for the explanation.
I like explaining this stuff because the book doesn't always.
No, yeah, that's why it's easy to read it, and if you have a general grasp, or like even if you're confused, if you have a grasp and somebody it's either ask the question or you're going to explain. Just makes sense.
Yeah, yeah, she was asking some really good questions.
Yeah, she's pretty good at this.
Yeah, she's done this before, I think.
Yeah,
Yeah.
I think she has. All right, thank you, sir.
Yeah, take care.
Hopefully.
Thank you. You too. Thanks for staying. Have a nice evening.